right, everyone, welcome back to a Grit Daily Startup Show. I'm your host, Jordan French. All the great pleasure of joining with us today, Jonathan Lowenhar of Enjoy the Work. Jonathan, welcome to the show.
Jordan, good morning.
Good morning to you. And to dive in, look, just to frame this one, there's an almost existential, question that a lot of our founder, CEO audience, and frankly, like entrepreneurs, a lot of us wear that label, many proudly. Jonathan, a lot of lurkers, they want to join a startup, start something. Our audience, well, our audience probably knows it itself is the best. I think the reason why I'm excited to talk with you today is you dive into a lot of the psychology, I would describe it to this audience. A lot of the psychology, a lot of the operational psychology that goes on and goes through founders and CEOs' heads. For those who are less initiated on Enjoy the Work, can you unpack that a bit more for us, Jonathan?
Oh, happy to. If you'll indulge me, Jordan, I'll tell a bit of origin story. If I go back in time, the gray in my beard gives some of this away, but I've been an operator for a long time and run a variety of different companies. I ran a large division for a big public company, then I was a private equity CEO, then I ran back-to-back startups. The first one I was co-founder of, and the second one I was the first non-founder president to join the business. And after all of those very fun tenures, I had this question, I had this realization that I think all well-run companies kind of do the same stuff. Like if you had a secret camera and you could watch them, you would see them do the same things. If the company was well-run, you would see that they had some vision, right? Some Simon Sinek reason for existing. They'd have some mission. Here's how we're going to do it. They'd have a current set of goals that they were operating against. They'd have some communication architecture in place, like how are meetings done well and how is information institutionalized and how does the left hand know the right hand, or how does sales know what product is doing. They probably had some value system in place. So if some employee acted like an asshole, they had a very quick way of engaging that employee to say, this is not who we are. Well, this curiosity that showed up for me was most of the time when someone's running a startup, they've launched a company for the first time, they don't have any of that experience or training. They just jump in through sheer force of will, through desire. Like, I need to birth this thing into the wild. And they go be an inventor and they go build a thing. And then if they're lucky, they're really freaking lucky, the combination of timing and market and skill and all the things, the market actually cares about the thing they bought and people start buying it and start using it. And then suddenly the thing that no one tells that founder is the moment that starts happening, their job has irrevocably changed. They're not inventor primarily anymore because that part's kind of done. Now they have to build a company around the invention. And what I realized putting those two stories together is we know how companies that are well run operate. Founders invent companies and they don't know any of those things, and they're really busy running this thing that they've now started. So how do you close that gap? And what I realized is there was no institutional infrastructure and startup plan to close that gap. And the audience that I thought might care about that, the venture capital community, they don't care at all. They don't. That's not their job. I'm not saying this with malice. I'm not saying this to be harsh. That's not their job. Their job is to go find the next gamble to make. And so founders are left to their own. So when you ask about psychology, is all founders who've had even a modicum of success, the first time especially, but not just the first time, they reach this terrifying moment of, oh shit, my job just changed. And I don't know what I'm doing. And I don't know who to ask. And I don't know who it's even safe to admit that to. Because if I admit it to employees, will they want to work here? If I admit it to customers, Jesus, will they really trust me? If I admit it to investors, will they put any capital? If I admit it to my board, they're going to fire me. So they just keep it to themselves, and then it's posturing, and a mask and armor and hope they don't get found out. And that horrible middle ground that plagues founders is the thing that enjoy the work is meant to obviate. They don't have to sit in that painful spot. Man, caffeine makes me long-winded. Jordan, I hope that was okay.
No, I love it. I love it. In fact, I'm visualizing this for our audience in one sense. There's a bit of a gradient, and everyone is on this curve that you describe. I think the only people who would say they don't have just a modicum or bit of an imposter syndrome or some self-doubt or uncertainty for sure, about all of the issues that you sort of raised or consequences of, that key moment. And maybe it's not an exact point in time, but like sort of there's a transition period, let's say, Jonathan. Anyone who says that they're not counted among those, I would say is probably a liar. And everyone's on the spectrum to some
a liar or Jordan, a sociopath. Either one's possible. Jordan, are you a sports fan?
To some degree, yes. Depends on the sport.
I don't care what the sport is. There's a GOAT. There's like some extraordinary player, regardless of the sport. Mm-hmm. And one of the things that we reflect back to founders when we meet them is I don't care how talented, skilled, successful, accomplished that athlete is. They have a coach watching their game tape. Move your elbow here, move your knee here. We should work on this. You did this badly. You missed this opportunity. It's why we're here. Everyone can get better. And so I agree with you that everyone has that moment of like, oh shit, am I doing this well? And if I'm a 5-time founder with 5 exits, there's still something I can get better at versus the 23-year-old who's doing this for the first time. And while they have a lot of confidence in themselves, the world is a terrifying place when you're a startup with low resources.
Yeah, absolutely. And the sports, loose analogy might not be so loose, especially the way we think, I think, increasingly today about entrepreneurship and leadership, rather, maybe more precisely, as performance-based, performance, almost like a performance sport. There are two directions I want to go in from here. One, I'll pull it back on the table because you mentioned VCs, but just so you know what's coming ahead of that, we'll set on the side of the table sort of what do most startup founders do now, these sort of like inventor, phase, and maybe perhaps just a bit beyond that in terms of what tools are available to them. Because not everyone, has a coach. So we'll touch on that topic next. But I do want to go back to the VCs because you established, and I think the observation is true. I know it's like a controversial one, but maybe a good way to describe it. Yeah, most don't really even touch upon or care too much about founder psychology. Is definitely true. Practically everyone that we speak to and know, they're religiously focused on the ROI. I think they're an equally totally misunderstood group. Not the topic of this podcast, but
Jordan, I gave a talk recently. You're nailing something that I gave a talk recently. I don't know, several hundred people in the audience, a mixture of investors and founders. And the nature of the talk was to share the economics of venture and the economics of the founder and the incentive structures between the two and where they're aligned and where they're misaligned. Again, not to malign either audience, but to recognize that there is a structural gap between the two groups, and talking about it openly can help. But one of the things that I asked the audience is I said, if you're a founder in a room, raise your hand. I said, okay, now I would like you to keep your hand up if you believe you have a rigorous and detailed understanding of venture economics, of how venture capitalists earn money. Keep your hand up. Almost every hand went down. And I said, okay, investors in the room, please put your hand up if you're an investor in the room. Hands go up. Please leave your hand up if you have a rigorous and complete understanding of founder economics. Every hand stayed up. There are just things that founders should learn. And there is this gap between the two audiences. and only one of the audiences has actually spent any time on it. So I actually believe venture has a better time empathizing with a founder than a founder has with empathizing with a VC. And if you want to build trust, you need to understand, you need to walk in both people's shoes.
Yeah, absolutely. Part of it is just, certainly I like that you don't, lay fault at necessarily anyone's feet. But usually, investor types have had some success, whether they're, good at selling securities, their own company perhaps at some point, from a revenue profitability, or from a, outright, trading their company. Or some other background in finance that's pretty extensive and some success in it as well. So often it gives them that strong leg up, and so I'm not too surprised to see the hands, the hands generally stay up. But I agree with you. To dive in a bit, I maybe have two anecdotes. I've even been part of some founding teams where investment probably killed the company, like being where the valuation was too low, a poor understanding, right, of like the investor economics. And then more recently, there's been a handful of companies, and I put my money where my mouth is, where they're probably not in a good spot necessarily to raise, even though they need capital. And one should and did and executed on alternatives to venture capital, because it just makes sense because of venture economics. And inverting that, probably, fairly, and not to be harsh, right? And I don't want to sound that way, but I don't know or think necessarily they totally understood to the use of the word rigorous, right, to describe it as an adjective there. An important one, a rigorous understanding of venture economics. I don't think they understand.
There's a line of questions, Jordan, that we put our founders through. It's a really simple line of questions. It's like, we'll start from a place of when we get to know them.
Yep, please do.
Let's imagine we're in a game show.
Mm-hmm. I like
and
it already.
And there are 3 doors on the stage. And those doors represent the outcome for the business you're building. And door number 1 is you want to go build something gigantic. Airbnb, Palantir, Uber, that kind of business. Mm-hmm. Door number 2 is you want to build a product that throws off real money, and in 2 to 3 to 4 years, you can sell that business. Door number 3 is a business that you maintain majority, if not maximum, control over, and it throws off interesting cash flows to you and others. It's a lifestyle business. Mm-hmm. And then we'll tell the founder, we don't care what door you choose, because we're not investors. We do care that you choose one, because it will determine a set of other choices. Right. And if a founder tells us door number 3, and there's any kind of interest in capital for that business, we want to make sure the type of capital choices line up with the door you're choosing. Mm-hmm. Choose door number 1, we're going after venture. If you're going to try and go big and fast with some of the current AI stories that are extraordinary, putting them off to the side for a moment, the majority of the world's gigantic companies need a lot of capital. Mm-hmm. Most people need other people's money to do that. Welcome to venture. But if you're going to go down that path, understand who you're raising money from and why, and what they care about, because they care about a gigantic outcome. Anything short of that is a failure to them. And they will drive decisions and try and massage the future of your business towards the possibility of power law coming true, and you can return the fund. Even if it means contorting your business in what could be seen as unnatural acts, like trying to grow beyond the physics of your business and what it's capable of. Because that's their incentive structure. That's not them being evil. That's their incentive structure. And it's simply different than a founder's incentive structure.
Yeah, absolutely. There was a nugget that I recall from relatively, I didn't know at the time, but famed investor, Howard Morgan. And I think generally the commentary around how much success, the percentage, right? Like you invest in 50 startups and, I've had 8 exit, and that ratio, in any sort of grade school paper or a math abysmal. But I think that's, a great way to sort of galvanize around, venture thinking, what venture success is. It's like low odds, and it's wild to listen to, and I'll paraphrase and maybe sort of project my perception of how he was describing this and thinking, and it's like, you need one or two out of like 50 or 100. Just keep going.
Yeah, let's use really simple math.
Yeah.
If I have a $100 million fund,
Exactly. Yeah.
my LPs probably want me to 3x their money, so a $300 million outcome.
Right.
If all of my investments on average, I have 10% ownership over them, that means I need $3 billion worth of outcomes
Yep.
to get to $300 million to have a chance to do it fund number 2. For $3 billion worth of outcomes, generally speaking, 60 to 70% of all startups barely return the invested capital. So that means a third of my startups have to generate that $3 billion. You're going to need a couple that are in there that are monsters. I say all of this within the context of, to be a great startup CEO is very different than being a great startup founder. And the founder is an inventor, but the CEO is the one who has all the skills around this. And part of the skills is understanding the economics of the business, from how to read financial statements to how to build a pro forma to understanding a cap table to laying out a capital strategy over time.
Yeah, and I appreciate that, the context, and we'll definitely stay within that. The only last anecdote was, I would say Howard Morgan's view, the math was even more extreme. It was almost as if you really just need like 1 or 2 out of 200 to go bananas, 1,000x, whatever it is. And that's really what they're trying to do, is hit not even home runs, to use a baseball analogy here, but grand slams. And almost everything else is irrelevant, where not 70, 80, 90, 99% of the stuff can go to zero. It's all about finding that, sort of astronomical, right? Like geometric return, which is eye-opening when you think about, if you're a founder, and you just come back to those, flip sides, you really want to evaluate, like, is this entity, able to pull that? Am I even in a market that makes sense? And overwhelmingly, it's a no. I'll give you one more really quick anecdote. We have the time. I was on a stage it was a wonderful experience in the Caribbean with Jenny Fielding on a panel. She's done really well.
Techstars, yeah. And she's got a fund that's doing well.
It's like called The Fund. And I remember, really great group of entrepreneurs down there. Great time to be in Jamaica, December. And I think the question,
feel free to invite me next time. This is sounding really attractive.
Yeah, there's some people to put you in touch with, but it was some of the startups, and this was to be fair, it was like last decade. It was a little while ago, and things have probably continued to really change there. But definitely quite a few founders founded what essentially were agencies, right? Like travel agencies and stuff like that, and had more than a few questions for her and people like her about raising capital. And I think it's another illustration of how wide that gap is. Not necessarily that they're at fault for not knowing. I think it's wonderful for them to ask the questions and really start to shape that. But it's illustrative and symptomatic of showing just how big that gap is and how little there really is of understanding. Howard Morgan's not going to invest in an agency ever, I think.
Right.
I mean, like, under what... so I digress, unless you have more commentary on that. I think door number 2 I really want to dive into, if you're up for it.
Oh, please.
Yeah, so I'll come at it from a different angle, and I definitely want to pick your brain on this, and it's strategic entrepreneurialism, which is actually a book that's required reading at, I believe, Berkeley and Columbia by John Fisher, who was a hat trick John Fisher, sold a company to Oracle that was Barossa, was the biggest one to what would later become Roper Technologies and AutoNation. And it's fair to say, and I don't want to rib him too hard, but I think I'll give you my opinion on him, is probably not that door. I believe it was number 1, the sort of go big or go home Uber. There's a lot of founders and even CEOs who are probably great, but they're not great at that, right? Like going from the what's money anymore, Jonathan? But going from like a $50 million to multi-billion-dollar valuation is a huge leap, and that doesn't mean that a $50 million or $20 million even or $10 million exit, it could be not, depends on what your goals are, and it's all relative, right? But it doesn't mean that you're not wildly successful if you're able to do that and have strategic exits and build companies. I think your point, and let me repeat it back to you, Jonathan, is to be deliberate about that, deliberate about picking a door. Jonathan?
Yeah, there are a couple of pieces to this. Founders will ask us often. We've worked with 200 plus founders now over the last decade. It's myself and a group of partners. And they'll often ask us, Jordan, how much capital should we raise? And we'll turn that question back to them. How much capital does the business need? So if I have a Series A company in front of us, we can, with reasonable accuracy, understand what metrics would be required for us to raise Series B. And then we can think through what are the set of experiments, actions that we think would unlock that kind of growth? What kind of resources would be necessary to take those actions? And now we have the capital we need. Add a little margin, because inevitably we're going to be wrong and stuff's going to go sideways. But I don't see the amount being raised as an ego question. It's a practical question. So when founders get a little lost in this game, it's because they're too busy reading articles of extraordinary raises at extraordinary valuations. And they get a little hazy in their view of just what does their company need for the next stage. We meet a lot of founders, Jordan, who say to us, I want to aim for door number 1 and go build something giant. But if 2 or 3 or 4 years from now, there's an interesting acquisition opportunity in front of us, we're going to be open to it. And I don't think there's anything wrong with that. But if they're open to it, that also then suggests, let's not use capital as a strategy to win. So if we need $20 million in the next round and we're being offered 50, and that could mean we take a capital advantage strategy versus the competitors, the downside to that is it probably takes that exit path to door number 2 off the table. And what we'll do then is say, let's remove ego. We have these 2 very different options, and if we take the larger capital, it means these set of choices probably go away, or at least they become lower probability. And then we talk it out. But can we start from a grounded place of, if I'm working backwards from a next round, what are the metrics? What's the work required? And what are the resources required to do that work? Always trying to train the founder to think in finance, to think like a business person, not just get swayed by headlines about amounts of capital raised by others.
Yeah, absolutely. I'm glad that you bring this up so early and sort of upfront, because I don't think necessarily that many founders have the opportunity to ask or don't even know this framework, and I think it'll be wildly helpful to our audience, and in some ways even people who think in this way, and maybe I do too, right? Like these buckets, it's even helpful for me to sort of reframe and think, okay, this is even more clear. I've got 3 doors, and these are the directions that you go in. I do want to
can I touch on that a little bit further as well? So many founders, particularly the first timers, Jordan, not grizzled veterans like you and me, they're so concentrating on the end game, what that exit will look like. And even if they get to that ending, that moment of celebration, that moment of joy is like 5 minutes.
Yeah, it's not much to it.
There's just not that much to it. I've had a wonderful exit in my life, and it's like, this was amazing. I'm going to go travel for a little bit. I'm going to get back to seeing my wife and going to the gym and now playing my daughter. Like, your life moves on. And so much of our work is designed of, like, what's the impact we want to have in the world? Are we working backwards from a door? Let's get a system in place so that you can get away from the imposter syndrome. You can stop being scared. You actually can learn what it means to run this business well, and not just the social emotional stuff, the hard skills of building a financial plan and how to hire well and how to organize people and how to get your team to move with urgency and what is an effective go-to-market strategy, like all that stuff. Because that's actually the journey. That's the joy. If you want to enjoy the work, it's the daily experience of running these things. if you have the celebratory moment 3 or 5 or 13 years later, great. But we want our founders to like enjoy the decade getting there.
Yeah, absolutely, and probably aptly named, for your consulting, your company.
Well, and also selfishly for my day to day.
Yeah, I mean, it certainly seems like you enjoy it. I think often that's the case when there's some, I find, some philosophy to it, and sort of, I'm into the same, right, variance of opportunity and to work on a whole bunch of different things. But to dive in one layer deeper, is there maybe a default among the sort of the three doors? And we don't have to really push on them too much, but just instinctively, my own opinion, and I think I'll withhold it. You probably guess what it is, but is there really a default sort of like human door where like the mega growth, the Uber is exceptional because there is some exceptionalism with it? Or is it a relatively even distribution, and it really just depends on other factors that don't really have to do much with sort
Jordan,
of like
this is a different conversation across the planet.
Yeah.
So if we're in the Bay Area,
Yep.
those founders want to go big. And by the way, their investors want to go big. And
Yep.
they all care more, generally speaking, I'm being reductive here on purpose, about the ceiling than the floor of an opportunity.
Mm-hmm.
Now, what we'll challenge that founder on is, do you want to run a billion-dollar company? That's different than saying you want to build one. Do you want to run one?
Mm-hmm.
And then we'll talk them through what that looks like. Thousands of employees, layers of management, offices around the world, traveling a great deal, a leadership team of 5, 6, 7, 8 people, all of whom are more expert in their area than you. That might be riveting to someone and absolutely awful to the next human. But if I'm talking to a founder in Montreal or Toronto, if I'm talking to a founder in the southeast of the US, if I'm talking to a founder in Western Europe, I'm going to have different answers about the size of the business I want to run. There's a founder of ours in Central Europe, and to protect the innocent, I'm not going to reference a name, and he's raised a bit of capital and the business is growing well. And if he can have like a personal outcome of $5 to $10 million, that is a generational shift for him, his family, his offspring, etc. His investors would be disappointed. But if he could sell the business in the next 12 months and make that kind of money, he's in all day. That is a rare personality. If I were to just drive 10 minutes north and be in a coffee shop in San Francisco, that's not the language I would hear. Mm-hmm. So here, yes, the exceptionalism that you're describing, the dreams of avarice are here for good and for bad. And in other countries, some combination of the founder and investor community are far more concerned with the floor than the ceiling. And they will protect and take a risk minimization approach once a business starts to show some credibility and momentum, rather than say, how do we pour rocket fuel into this to see if we now can be one of the 20 companies that shapes the world over the next decade?
Yeah, absolutely. And, within that vein, I'll give you also my opinion, and maybe I'm wrong, and you can check my assumptions on it, but possibly it's from my own experiences, but especially for those who, have got a full-time job, I call it having one client, Jonathan.
I like that.
Right? Like consult, it often doesn't require any capital or much, right? The runway is whatever it is for yourself, hang a shingle. And maybe that's also a product of the questions, that I get or we get generally, right? Which is that transition from a full-time job, or maybe a first startup or attempt, maybe didn't quite work out. Consulting is a pretty nice, sort of gateway drug, if you will, to the broader realm of entrepreneurship. Just my 2 cents in the play. How'd I do, Jonathan? Thoughts?
I think you did really well. The upside of consulting is similar to the upside of running a startup, that you are your own boss. You answer to no one, or at least that's the feeling you hope to cultivate, that you have a great amount of daily freedom. You work when you want, from where, with whom. It's not to say that there aren't pressures. There's this book that I really enjoyed a number of years ago, the Mark Manson, The Art of Not Giving a Fuck.
What was
Are you
about,
familiar with this?
Guessing, yes. Mark's great. That's probably, the title says it all.
Well,
Okay.
there's this principle in the book that I really enjoyed, that humans get lost in the pursuit of solutions. They think that if I just do this, this is solved. If I just do this, this is solved.
Right.
And he argues that there is no truth to that. In fact, we just get to try and choose problems.
Yep.
And a good life is choose the problems you want to have.
Right.
So as a consultant or a startup founder, I get the new problem of I have to go hustle on my own to go get paid. Instead of the W-2 paycheck, the insurance that's covered, the office that's comfy, but it has its own set of problems of corporate bureaucracy, or I am now simply a spoke in a large wheel, or I don't have the agency I like over my day or my month or my year. Mm-hmm. It's choosing a different set of problems. And I think entrepreneurship and consulting are similar to different set of problems. And it's just happened to be ones that I think you, we like these problems better.
Yeah, I mean, shout out to Mark Manson on it, and another endorsement for the book. Not the worst idea for those who are sort of in that transition, or if, maybe things didn't work out a first, second, or third time. But I think there's probably more to work with there, and probably that book's a good read on that note. And so, look, the industry that you're in, I think is another sort of interesting way to work that lens. There isn't, to my knowledge, like a McKinsey or I'll give in more grandiose. There's not a Citigroup or Bank of America, right? There's not some giant consultancy that works with CEOs. It's a bit of almost like a cottage industry. Where I'm going with that is actually the inversion of that, Jonathan. That really, let's venture. I mean, 9 in 10, startup CEOs don't really have much more than a flimsy, sort of advisory board, if we even dare. It's like a marketed advisory board. Let's be honest.
Yeah.
Actually, let's rip the Band-Aid off. Let's get real on this one. Most decks I see have advisors, and they barely even know that they're on there. I've seen startups go as far as shop around for like bigger name advisors. My point is not that that's necessarily nefarious. I'm just saying that simply, distilled, right? They don't have you. There's not another, other Jonathans as well for what's got to be a very high percentage of the universe that, you sandbox in. Is that a reasonable?
It's completely reasonable. I see traditional advisors in 3 groups. There are domain advisors. These are folks that are expert in your industry, your vertical, your space. And as a CEO, you want them because they have access to gatekeepers.
Yep.
Right? They can walk you in the door and things that matter. Generally speaking, those are high value on a short fuse, so value degrades pretty quickly over time. You might meet them once a month or once a quarter for a cup of coffee or a virtual chat. You spend half the conversation re-updating them about your business, and then hopefully they make an introduction that matters.
Yeah.
The second one are what I'll call functional advisors. And these are folks that are an expert in sales or in some part of product or in some part of engineering, and they're very narrow and they're high value, usually for a very short duration, but they are functionally helpful because you're a CEO who's never run that department before. You're not even sure how to hire the right person for it.
Yep. Systems important.
That's right.
Exactly. Yeah.
And then I think that there's this third group of founders who are advisors who are just former founders who've had some success, who are between gigs, generally speaking, or they're doing a startup that's early, or they're just writing some angel checks and they're advising on the side, and they're well-intentioned and they're really bright, but there's no pedagogy, there's no curriculum, there's no systems. They just know how to run companies the way they've done it. Mm-hmm. And so they make themselves available and they're really capable people. They make themselves available to CEOs, and they get on the phone and say, what questions do you have? My point of view is, well, all of that has utility, and so do CEO peer groups. They have utility, and some WhatsApp and Slack groups and Signal groups that are out there, they have utility for crowdsourcing answers. There are networking programs like YPO and EO and those kind of things. They have utility. None of them are, said differently, training. And they all require the CEO to know what question to ask of who and when. Mm-hmm. And that's a dangerous gap. And so our point of view is we know what makes a great startup CEO. We've studied this exhaustively. We've broken it down into component parts. We know how to audit someone. We also know how to audit a company in a really rapid fashion to say, how does it go from here to there, like A to B or C to A, et cetera, so that we can put up a mirror very quickly and say, okay, here's what has to change about the business, and here's what you have to get better at for this stage of company. Do you want to work on this? And then we have a system for how to work on that. So every week we're getting a little better. It's a difference in going to the gym and you see someone who has good form and just asking a rando, hey, can you help me with this? Versus you're working with a strength and conditioning coach every day who gets to know your body, your form, your goals, and every single day you try and get 1% better. We're in the latter category. It doesn't mean it's the only way to get better. It's just our approach to getting better.
Yeah, absolutely. I mean, the relatively loose, but maybe not so much, again, gym analogy, similar to a sports one, is also is apt, is someone who's, sort of self-exercised. Is that a good way to describe it?
Sure.
Yeah.
Or getting on stage in theater with a director or playing a musical instrument in a band. You want the expert third party to say, hey, that wasn't quite right.
It's indisputably an accelerant, especially when it clicks and works. And I'll dovetail that into sort of the advice that most startups and scale-ups, that run through here, that they get. It's fascinating. It's a bit narrower, and I do want to run this by you and can pick it apart. And that is, it's something that you started to touch on a couple paragraphs ago, which was try to find someone who's already been successful at what you're doing. But it does seem incomplete. It does seem incomplete insofar as, perhaps more than a few ways, Jonathan. But what immediately comes to mind is they're most likely going to be either non-incentivized or low-incentivized domain expert, systems expert, as we sort of somewhat agreed on that nomenclature, and or this sort of drive by, oh, that's cool, they did this, but it was also sometimes at a certain point in time, and I can't, whenever this comes up, and that's the advice or recommendation, I don't miss that some things are temporal, meaning you could hire, and this isn't even just applied to advisors, but that's germane to this conversation. Markets really move, and just because someone's successful at something, 1 year, 2005 or 15, especially with significant time,
can we separate outcome from the work?
Absolutely.
There's a founder of ours that I think is a good representation of this. When we met him in 2016, Jordan, he was in his mid-50s, had already had 3 exits, incredibly capable operator, married for 20 plus years, 2 children. This is in every way a capable, fully functioning adult who knew how to run a company. Yep. And his desire to work for us was really it was such a clear definition of why we think this work matters. He said to us this very simple phrase, I only know how to run companies the way I know how to run companies. I would like to learn how the best companies run, and then we can play with the difference. All my partners and I do, and we're not the only ones in the world who do this. I don't want to present ourselves at the top of some silly mountain, but all we spend our time doing is studying how great startups do something from like meta topics to moving from founder-driven sales to building a machine to really tactical things. We're helping one of our companies run their first leadership offsite ever. It's a 60-person company, millions of dollars in revenue, profitable. It's a good business. They've never done that before, and they're facing some really interesting big questions as the competitive landscape in their space changes. So we're going to teach them how to run an offsite well. That's not something you can kind of just pick up at random. And LLMs will help, and books help, and blogs help. And what we hope to do is contextualize, we know everything about your business, and we have these skills, and we can put them together with you. And there are founders who want that kind of support, and we're here for it.
Yeah, and that anecdote's helpful. It gives you a really maybe concrete use case that maybe not everyone's thinking of to apply, some of the resources that are available. Going back to maybe even the way you open this, which I think was interesting, to sort of reframe that, is a bit of a stigma, right? Like ironically, there's no stigma around hiring an exercise, gym coach, and certainly strength and conditioning is like, that's awesome if you're an athlete. It's almost like a signal to the market that you are a good athlete or a great one or an important one, right? And it's almost ironic that in sort of the startup universe, there at least in the past has been a stigma. Has that started to evolve? Has that changed?
It has. I feel like the zeitgeist has shifted there.
Yeah.
Not completely. It is still not generally okay for a CEO to in any way to signal weakness. So even the words they use in engaging an advisor, engaging a coach, and engaging a mentor with whoever they might need to socialize this opportunity or get permission matters. So, for example, we'll take two different companies. One that engaged us or wanted to engage us because the business hit a plateau and was starting to fall. Mm-hmm. They had raised a lot of capital. There was a lot of money on the stack. There was a big team, first-time founder, working her ass off. And she learned of us. We spent a bunch of time together. We vetted the hell out of her and the business, and we decided we're in. Her going to her board and saying, want to engage, enjoy the work, it's hard to position that without the board thinking, so we have a company that needs a turnaround and you don't know how to do it, so you want help? Then do we even have the right CEO? It's a delicate conversation. Now, if the CEO has managed their board well and has real trust with the board and has a way of articulating, here's the upside case of us all working together, great. The second scenario is a CEO where the company's flying. The company's doing great. And they go to the board with a similar ask. Well, that founder is going to have all sorts of leverage. The board's probably going to say, whatever you think, let's go do it. Now, they'll still be worried potentially about who is this firm that's whispering in your ear? Are they going to say things to you that are inconsistent with board mandate? At which point, hopefully, we'll get introduced to the board and we'll have a very simple conversation. Our job is to help the founder get better and help them execute whatever the board decides is the strategic direction for the company. And that happens to be true. We're not here to do something inconsistent with the board. But those are two very different reactions investors could have.
Mm-hmm. Yeah, and you anticipated my question, which I was wondering if you got asked much about it, which is, do you get hired right in that position, often the category one, where not even just to go work on something, but to work on the comms, right? The how do we navigate, what do we say, ironically almost the potential stigma, whether it's perceived or real, or both. Yeah. Could be both.
Jordan, we have a joke that we talk about internally. We say that we are the only consultant you'll ever meet that loves scope creep. Mm-hmm. Anything a founder wants to engage us in, anything they ask of us, our answer is yes. Mm-hmm. Our only qualifier is we're not going to do their job for them. But that means we end up doing some weird stuff, like editing emails, reviewing a text thread,
Right.
having a chat with an employee, interviewing people, running offsite. It doesn't matter. Like, we want to be in it with the founder because, generally speaking, they're working harder than us, and their life isn't always that much fun.
Yeah, certainly. And then naturally, as we sort of get towards the end of this episode, I'll definitely give you the last word. But before we do, there's so much to consider, so many sort of tools that you might have at your disposal. Are there any in particular that you see come up again and again that could apply perhaps to your own work, right? Your own thinking about what you do. Perhaps, for example, right? Like,
I feel like you have one in mind. What's a tool that you're using?
I really don't. It's almost like asking, if there's an absolute fitness pro, right? Or we could choose other loose analogies, right? But you have an opportunity to ask a Brian Matza or some other absolute fit freak pro, which is awesome. Hey, like, what are you working on? Like, what are you looking to push that envelope to even sort of operate better with operators working to improve their own acumen as a startup founder in any of these scenarios. Just sort of curious question there, and something you could expand on, Jonathan?
Yeah, there are frameworks and tools, Jordan, without a doubt, that we've authored, and then there are a variety of others where we've seen someone else create something that we think are beautiful, and so we learn them and try and apply them. I think this answers your question. There are maybe two regular disciplines or rituals that we have that I try and use on a regular basis that give me not only a lot of calm, but a lot of productivity. And the first one is, at any given time, a startup, a person, your life, you're working backwards from something. And can you articulate that thing in detail? So we say to founders, you're always working backwards from one of three things: a fundraise, an exit, or profitability. And you got to pick one because it ends up determining a lot of other decisions. In the same way, every year coming into a year for me, and calendar year is a little arbitrary, but it's the one I use. If I look backwards from 12 months from now, what do I want my year to be like? Financially, with my family, physically, what do I want my professional life to look like? And then the second one that dovetails into it is language that we use where our calendar reflects our priorities. And so, Jordan, you and I know founders, and we can kind of reduce them to two different types. The one that gets through their day, and at 5 o'clock, 6 o'clock, 7 o'clock, they're pushing their fingers through their forehead like they have a migraine, they're holding back, and they say something like this: where the fuck did my day go? Man, now I can actually sit down and get some work done. Founder number two, at the end of their day at 5 or 6 or 7 o'clock, they're like, that was a productive day, and then now I'm going to go exercise and spend some time with my family, or see a friend for a drink, or have dinner, and gear myself up for tomorrow. The second one is someone who is actually controlling their calendar and deciding what gets on and what doesn't get on, as well as making time for what Paul Graham would call maker time. Mm-hmm. And the first one is someone who is passive and at the mercy of their calendar and just says yes. Most founders fit in that category, and as a result, their days just get away from them. Everything gets booked. And so if there are two rituals that I'm regularly applying for myself is, what am I working backwards from? And does my calendar this week, this month, this quarter reflect my priorities based on what I said I'm working backwards from?
Yeah, appreciate that. And I think you answered another question that I thought about asking instead of the introspective version of applying this to yourself, but it's simply, what are the tools that we could all use? And I think you answered that really well. And as you were speaking, I could personally relate to both buckets. I've been there for sure. And for the audience out there, I think also, you'll echo this. It's just to be in the fight is the win. You're somewhere, and if you want to get somewhere else, work towards it, whatever that goal is. And even if it's as simple as a freer calendar that you're arbitraging away, and thinking about what are the best uses of my time, you can certainly get there. I'll say, not too many years ago, I had an absolutely full calendar and was making quite a bit less, financially. Not that that has really much to do with it, especially nowadays. And I think you appreciate that note, Jonathan. But a lot of people were surprised to hear, they're like, when we can do a call? I'm like, well, here's my Calendly, but, I'm wide open. Maybe there's a call a day or something along those lines. Usually it's the podcast, quite frankly, which I choose to do, to, go back to words that I'll borrow from you here. And that's a powerful place, it seems, to live, which is using that word. I choose, do what it is with my time.
definition of healthy, Jordan, is like I'm protective of who I spend time with. Mm-hmm. I am protective of the food I eat. I am protective of the time spent on my physical health. I am protective of my precious time with my wife and my little girl. I have a 4-year-old at home. Why wouldn't I be protective of the 8 or 9 or 10 or 11 hours that I'm going to work as well, and look across the things that are on that calendar and decide, not with any arrogance, just are these the right ways to use my time? Because in 5 minutes I'm going to turn to dust and this will all be gone, whether it's a simulation or otherwise. I want to spend this time well.
Yeah, absolutely. And I would say, that's a great note to end on. But I did say I would give you the last word. Maybe that was it. But words of wisdom from Jonathan, and then I have one more note for you. Actually, let me give it to you first. I have to get this to you first. It's because it's important, and anyone and everyone in the audience hears this sometimes. But if you just really think about the just enormity, there's an infinite amount of work out there for you, Jonathan. I mean, especially you. I did start to bracket it a bit, thinking about, well, wait a minute, like not even 1% of startup founders have a coach, but it's voluminous. I mean, it is endless. So many people want to start companies. It's even for Gen Z, which is like the YouTube generation. It's like number 3 or 4 on the list is entrepreneurship, which by the way I think is both enlightening but also encouraging, perhaps. But that is a huge body of potential clientele, or maybe a better way to put it. There's just a lot of people who need this sort of help, the conditioning, the strength and conditioning. Just an observation, Jonathan, that maybe you think about. I had to give that one to you because I think the audience is thinking the same thing. They're like, wait a minute. And
Jordan, it's part of the reason why we've been so limited in the number of founders that we could serve over the years, because we're a service business with a finite number of partners. There are only so many companies we could work with at a time. And so as a result, we've had to turn away more founders than we could ever work with. We've changed that, by the way. Like, we're now launching boot camps so that we can work with a cohort of founders at a time. The first one's in October. The next one will be a global one. The one in October is in San Francisco. Then there's a global one that's going to be offered in November. So that it's a smaller scale. These are going to be 2-day intensives. But what they allow us to do is hopefully help a lot more founders at once and not have to turn quite as many away.
You end up with the same scale problem we all seem to. Perhaps there's some AI solution or app element out there for another day, Jonathan. Like I said, I will give you the last word. Jonathan, fire away.
I think what would be what I would have wanted to hear 20 years ago is that for the founders who are listening, those moments where you wake up at 3 a.m. with the existential dread of like, oh my God, I'm fucked. And my employees are going to be laid off. My customers are going to be disappointed. My investors are going to be pissed. You're not alone. All founders feel that way. All first-time founders feel that way to an extreme. And part of the way you can move from daily dread to, dare I say it, daily fun is by learning the difference between signal and noise, by learning the basics of how to run a company well, because you've already learned how to invent something. You've already learned how to sell something. Otherwise, you wouldn't have capital and customers and first employees. You've learned the basics of those things. Now you want to systematize them. Whether it's my firm or many others, there really are a lot of people who do similar work. Don't suffer in silence. Go get some help so that those moments where you're like, I don't know if I should go left or right, and I don't want to admit it, and I really am a fraud, and like all of those feelings that, yes, I had them 20 years ago. You don't have to. I will share, if you do have a board of directors, don't admit it to them. That's not a safe audience. You have to admit it to a safe audience. That's other founders, and that's people who work directly for you. So one of the pieces of wisdom I will share is if you're open to it and you stay curious, there's someone in your life, you can already think of them. Like, oh, every time I talk to Jennifer, she has the right things to say. Great. Go see if Jennifer will spend more time with you. Don't sit in silence about this. You'll have so much more fun if you don't.
To the toast to the Jennifers, if you will, of the world. Jonathan, that's all the time that we have. We're getting the green flag from our editor, but hope you enjoyed this episode. For all of those out there listening, you can enjoy this on any of your sort of favorite platforms, especially Apple Podcasts and Spotify. I think we're on a few dozen others at this point. And then for those of you who like to read along, and I do too, this article version of this will be on Grit Daily, and of course our wonderful partners at Apple News. And thanks again, Jonathan. Really lovely having you on this episode.
Jordan, this was so fun, and we'll talk again.
Yeah, certainly. And last I'll say, because I'll admit I forgot just a moment ago, but for those who want to reach you, what's the easiest way, John? The easiest way is enjoythework.com. There's even a contact form on there. We are obsessively responsive. We try and work startup hours and be startup available. We also have some of our content that's on there. We have a playbook on there to teach founders how to be better at hiring. We have a playbook that's on there for free to teach founders how to move from founder-driven sales to building a go-to-market motion. Go there using good health. Yeah, that's Jonathan Lowenhar. Find him at Enjoy the Work. That's ENJOYTHEWORK. Did I get that right? And that's a .com.
You did.
You got it, everyone. Well, until next time, thanks again, Jonathan.
Thank you.